Anthony, come back on anytime, eh? We like you. We are live. We are live. We like you, Anthony. Anthony's so guys, we are live. And then we're gonna get into this mortgage stuff because this is probably the biggest change in some of the mortgage options that I've seen. I don't know how you guys are feeling about it, but years and years and years, I haven't seen something like this. So we're pretty excited to share all this stuff. But I just wanted to get back to the important point we were talking about with Dan, Patton, Lorenzo, Podda. I'm going to get you guys to introduce yourselves. But Dan, yes, you were way offside when you took a knock against the Bills yesterday. And karma did hit, because anyone listening to this, just so you know, Dan was going to play golf yesterday. And he sends me a text, and someone else on the team who's a big Bills fan, just basically knocking and laughing about the Bills. And then you went to play golf and you played a horrible game. And that's just karma. That's just how the world works, Dan.
You're downplaying.
We're like in the off season. We're not even like in season.
If you're gonna call me out, at least give me credit for the chirp, because it was a good one. I'll just to summarize really quick for everybody. The Bills have an
look how much you like your chirp. You have to summarize it. Go ahead.
The Bills have a
tell everybody how great your chirp was.
The Bills have a theme song, and the theme song is basically about a down in luck guy who ends up losing his girlfriend to another guy, and he's Mr. Brightside because this happens. So it dawned on me that for the Bills, the girl in that song is the Super Bowl, and the guy who she's cheating on him with is Patrick Mahomes, the Chief. So I thought that was an interesting observation that I would just share with Tom and someone else. So yeah, so I deserved a bad round after that, but I stand by that.
It was reading your text. It became so obvious how much joy sending that text.
It was an epiphany moment. Sometimes it's with mortgages and real estate, Tom. Sometimes it's with sports chirps. That's the way.
Okay, so I've been following the Bills, and we're going to get to the mortgage stuff, I promise. But I've been following the Bills off season. How's Casey looking? You like what you're seeing?
I mean, really? It's Super Bowl or bust at this point for us. I mean, you guys will have a great regular season, which you always do. Can you get over the hump? That's the question.
Lorenzo, you see he continues the backhanded compliment.
Yeah, the way he says that too.
I'll pat you on the back. I'll just pat you on the back. You guys are good. Good little team.
As a Jets fan, I just sit here quiet and wait.
Yeah, Lorenzo can't say anything as a Jets fan.
Oh, jeez. Are we all Blue Jays fans at least?
Of course.
We agree on that? Yeah.
We are.
Yeah. Okay. Okay. So for those who don't know you guys, can you guys just introduce yourselves just to get us started? And then we're going to dive into this new mortgage stuff.
Lorenzo, you go first.
Absolutely. Yes. So I am Lorenzo Podda, my partner here, Daniel Patton. We are from Better Mortgage Select. We've been running Better Mortgage Select as a kind of full service mortgage brokerage for as in this current form as Better Mortgage Select for a few years now. Started as BM Select, so probably 4 or 5 years now in this current wave, but also be with our pass-through Butler Mortgages as well for over 20 years now. And we kind of made a specialty in working with real estate investors, obviously with teams like yourself, with Rockstar. And we kind of specialize in helping investors grow their portfolio, getting them really good mortgage approvals, and kind of putting them on a path where they can continue to buy and then enjoy, hopefully in 5 to 10 years plus, the fruits of their labor and investing into real estate. So that's kind of a nutshell about us. We're a full service mortgage brokerage. So myself on my end, I more so manage the day-to-day operations of the company. So the back end side of things a lot, where if someone's coming in with their documents, I work with all the underwriters on our team and at the banks as well, kind of working on getting those approvals, trying to make sure the file is running smoothly from start to finish. And I'll let Daniel jump in.
Yeah, thanks, Lorenzo.
Yeah, great. So for those that don't know, my name's Daniel Patton. I've worked with Tom and Nick and the Rockstar team for over 15 years. To Lorenzo's point, we work a lot with investors. We're constantly trying to find ways to create value in the mortgage world, in a world that can be difficult to borrow money in, difficult to deal with banks, paperwork. So we try to separate ourselves in this specific market with different programs. I've been doing this for 20 years now. I handle most of the sales. If you think of our office, I always like to tell people we're like a restaurant. I'm the server. Lorenzo and his team are like the chefs in the kitchen, cooking up all the deals, all the special programs, and we make a great team, and we're able to deliver that to the clients. So that's a little background on us.
Thank you, gentlemen. And I think in the background, I think Anthony almost has that presentation ready. Lorenzo, if you do want to reference it in the future,
Yeah,
but
we'll let you know.
okay, so let us know. So then, so how do you want to kick off here? I guess the reason we wanted you on this and we wanted to share it with everybody listening is that it seems like you guys have some new mortgage products that I've never really have heard of in this capacity before. So do you just want to dive into them? I think is it two announcements or three? It's
well,
three?
technically there's so yeah, I'll dive into it, but technically we've come out with 5 new products.
Okay, but I think the first one is going to take the majority of time to talk about, right? Yeah.
Correct.
So okay, so how about it?
Yeah. So basically, so to give everyone a little bit of a background as well. So basically, we obviously, as mentioned, we've been very, very big in dealing with real estate investors over the years. And as soon as we started to see back in 2022, the rates start to increase for a lot of real estate investors, and you saw values drop. It started pricing out a lot of real estate investors, and that market became very quiet. And so a big thing that we were obviously sitting there looking at over the past probably about a year and a bit now is how do we bring the real estate investor back, and more so, how do we make it make sense for real estate investors to keep buying properties in Southern Ontario? We were at a point where rates were ridiculously high, so purchase prices were ridiculously high, cash flow didn't make sense anymore, and it was getting really tough. So we kind of sat there and said, okay, well, what would make sense for real estate investors to be able to start purchasing properties again and being able to finance their properties, and where again real estate investing is back to where it used to be. And so one of the things we started thinking of, we had an idea of a couple different products we could create that would say, hey, this is something that maybe will help real estate investors continue to grow, and something that we even looked at our own portfolios, Dan and I and Dave and Mike, and we're kind of like, hey, would this help our own portfolios in real estate? If the answer was yes, then that is something that we could definitely take a look at. So we ended up coming up with basically 5 different programs that we thought would help. And basically what ends up happening is, as soon as you now think of, hey, here's something that would help real estate investors, okay, how are we going to bring this to them? And so the easy part was coming up with the ideas, to be honest with you, and being able to say, hey, here's what we're able to do. The tough part then becomes, okay, well, now if we have hundreds of investors that want to do this, how are we going to finance it all? Right? How are we going to get them the mortgages that they need? And so we started a journey basically working with a number of different, we'll call them financiers effectively, but funds, different large institutions, of saying, hey, here's a type of client that we work with. Here is basically what they do. Here's what they're purchasing. Here's a history of what we've done with these types of clients. Here's the products we want to be able to give to them. Are you willing to kind of invest in this opportunity? And so obviously, I'm sure, as Tom probably you've explained on millions of podcasts, to deal with big funds and institutions like this, it's the worst. So it's very, very difficult. And but over years, or not even years, but probably a good 9+ months, we ended up getting what we call the BM Select Investor Edge. And so it's a white label for a bunch of different investor products that we've been able to come out with and create. So that's kind of the backstory of it, of how it came about. So it is exclusive to our brokerage, having all 5 basically products that we've been able to come out with. They are exclusive to our brokerage. So we obviously, like, we started debuting and kind of beta launching it through Rockstar. Obviously, we talked about this a couple months ago on the webinar. And so it's been going pretty well. And so now, and probably come Labor Day, just after Labor Day, we're going to do a full launch to kind of the world. But it was definitely launched first with Rockstar, which is good.
Yeah.
And so, yeah, so I'll kind of dive into it at this point as well. And kind of
let me jump in, Renzo. Let me jump in really quick first. Before we jump into the first one, Tom, I think that, to Lorenzo's point, it's the investor game, and I know you'll attest to this, a lot of the investors will. It's a game of evolution, and we have to evolve as investors. And what might have worked early on evolves into something else. I know when we first started working back in the old IFL days, the income for life days, a lot of rent to own was a strategy that made sense. We did a lot of rent to own, and that sort of evolved into single family homes, renting and holding. And that evolved into buying multifamilies, which involved into BRRRR strategy. So we're always trying to find value with real estate investing. And what real estate investing, the real value we're looking for is 2 things. One, we want equity appreciation. We want that pop, right? We want that when the market's going up 5 to 10% per year, we want to ride that wave. So we want to create value in terms of equity in a home. We also want to be cash flow positive. That's the two things we sort of focus on, the appreciation and the cash flow. So the first program that Lorenzo is going to talk to everybody about it helps bridge the gap. And that's what makes us so excited about it, is this is a new way to create that equity appreciation, similar to a BRRRR, but different, which we'll explain, while at the same time adding that cash flow injection that we need to cover, the higher costs of carrying these mortgages these days. So that's what gets us excited, is it's a new evolution for investors who are looking to find ways to create, wealth and cash flow.
Awesome.
Yeah.
Okay.
So yeah, we'll jump into it.
You guys have built it up. You guys have built it up. Yeah, you did a great job. You did a great job.
Yeah. The first
I'm a
program,
sales guy.
Yeah. No, but you're proud of it. I get it, and you should be. So let's hear it.
So the first program, we call it Build Up by BM Select. And so basically what it is in a nutshell is it's renovation and construction financing, basically redefined. So a lot of times clients will say, hey, listen, I'm wanting to do a large scale renovation on my property, or investors, I want to add a garden suite. I want to add a duplex to my basement. Or even simply, hey, my tenant tore up my house. I want to be able to do some renovations to and be able to re-rent it. And for a lot of investors, the challenge is, how do we come up with the funds to be able to do that renovation? And so obviously first thing is, hey, do we have current equity in our property? Now, 2020, most people had equity in all their properties. In 2025, a lot of that equity, especially if you bought recently, has been eaten at. So there isn't necessarily a ton of equity to access in a lot of investors' properties that they can go and fund a $200,000-$300,000 garden suite addition, for example. And so that's where we started to find a bit of a middle or a tough area. And so the answer to that problem a lot of times was, hey, can we go find and get a hard money loan or a private lender or someone willing to give us a loan at a ridiculously high interest rate so that we can do all the work to the property and then hopefully go to a bank when it's done, hope they see the potential and what are the actual work that we've done and they like the new value of the house, and hopefully they give us a refinance so I can pay back my private lender and all my fees that I've incurred, and hopefully I can get everything wrapped all into one. And so there was a lot of, and the key word in that previous way that things were done is the word hope, right? And so because hope doesn't always translate into what ends up happening. And so that was obviously a big problem. And that's something that, to be fair to a lot of investors, steered them away from adding multiple units to properties. And so what this program now does, it allows us to work with basically bank-like interest rates the entire way through a process and get a renovation loan that's approved upfront based on the work you're going to be doing. So in an easy way to kind of look at it is an investor will come and say, hey, I have a property, I'm looking to buy a property. It works with both purchases and refinances. And currently it's one house, single family home, but they have the potential for a garden suite. I've gotten a quote, the garden suite's going to be $250,000 to build, for example, and I want to be able to finance it. So on our end, we'll start working. We'll make sure obviously the qualification works for the file, because we still have to qualify as if it's a normal mortgage. And then we'll say, okay, so you now qualify. We know you can afford this much of basically mortgage financing from us. Once that part is kind of cleared up, we can then go to an appraiser and get the appraiser to give us an as complete value based on what the property is going to be worth once the work is done. So it doesn't have to be done, doesn't even have to be started. We just have to tell the appraiser, here's exactly what we're going to be doing. And so that's done via the construction quote. And so the appraiser will say, well, when that project's done, it's going to be worth an extra the whole property will be worth an extra $300,000. We can then give you an approval based on that as completed value. So the property value jumping by $300,000, for example, assuming the appraiser says that. And then what that allows you to do is it now gives you the exit, knowing I know for sure once I put the money and finish the work into the project that I have an exit that's already locked in, and the hope gets taken out of the equation. So I know for sure now is I'm going to have a very good interest rate when we're done. I'm going to have a typical traditional mortgage. So I know that there's a strong exit here. And then becomes fill the gap. So how am I going to get the money in the meantime for the $250,000? Well, through this program, we're also able to set it up as a construction style loan where there's draw structure in place where you can now get the money slowly as you finish the work on the project to be able to fund that garden suite addition, for example.
Okay, so I have questions for you on
Yes.
all of this, and I'm sure you're going to go into more detail. But the first one, I just want to make sure we're clear, is can the bank change? Like, I guess this is pretty new. If they give us, like, if I was going to buy something at $750,000,
Yep.
the house, and it was going to cost me $250,000 to put in a garden suite,
Yep.
The banks now, and I can show, here's the quote from a contractor that it's going to be 250. They're now going to lend against $1 million. Or sorry, if we said the value of the property is going to increase 300 grand, then it'd be $1,050,000,
Yep.
and they're going to lend against $1,050,000.
We'll be able to approve you based on $1,050,000, correct?
Okay.
Assuming you qualify, assuming that person qualifies for an 80% of $1,050,000, like an $825,000.
Yeah, got it. You have to qualify. Okay.
Yeah.
At the
assuming you
bank, I
qualify,
guess,
yeah.
because the funding is done, the bank can't really change their mind. I guess I'm just trying to figure out, where do I get?
We will be getting you, like we will issue you, because obviously it's through us. We'll be able to issue you, because it's controlled by us, a commitment letter that has your basically what it will cost during the project, how the draw structure will work, and then also here's, as soon as you're finished, what your mortgage will transition into. So those
I have to qualify.
are done up front.
Okay, so this is like the reason I think Nick and I were both so excited about this is that in the past you just had to hope that you would get the appraisal that you wanted after the job was done, and you were just praying that you would be able to like get some refinancing done. In this way, you just know up front, hey, here's what I'm dealing with. So you're removing a lot of risk and uncertainty right up front. But what do I need for the construction portion? Because you mentioned it's going to be done as a draw.
Correct.
So I have to qualify at 80% of the higher value. I got that.
Yep.
And then to access the component of money that is the construction component of the financing, what do I need personally to get that draw flowing?
Yeah, so our rule is you only need 15% of the construction budget in your own funds. So let's say your budget is going to be, just for easy numbers for everyone, $100,000. We only have to have the investor only has $15,000 to start the work. And so the initial start of the work is done with your own money, your 15%. Once you basically use up your funds, we can then send the appraiser back out there to determine the percentage you've completed the project now. And so let's assume you get to, once you put your 15% of the money in, let's assume a bunch of work's done, you're at 15% completion or 20% completion or 25% complete the project itself. The draw will then kick in at that point to fund as how much your percentage complete is. And you can use that draw to then keep paying, obviously, contractors as they finish work. And those draws will come so on and so forth until we basically have used up all of the draws. Your work is done. And then the mortgage then gets transitioned into like a typical traditional style mortgage, paying principal and interest, everything like that.
And so far, you've seen what kind of success with the appraiser who's going out? Because I guess everything is determined on them going out to look at the project. Yes. And deciding, is it pretty good? Like if I had a $750,000 property and I was going to do a garden suite that's going to cost me $250,000, are you seeing them come back at least at $1 million that I can borrow?
Yeah, we've seen it. Yeah, so it's a lot of it. And this is kind of the tough part of the garden suite world. Still, a lot of it's location dependent. So if you're in an area where you're literally the only garden suite, obviously the appraiser is now. And one thing we've been able to get the investors basically that we're putting the money in for to do is we've been able to get them to instruct, and obviously we're able to now instruct the appraiser, and they're okay with it, is to be able to say, hey, value it, make sure that you know that there's a garden suite producing income there, like value it based on that. So they're now looking at comparables in the area as well as obviously the addition that you've done to the project. So it's been okay, to be honest with you. We haven't had anything like astronomically bad. You're going to obviously get areas where there isn't any garden suites, or someone maybe overspent on reno or is going to overspend on renos and it doesn't come back where you want it. And so that will happen. But so far, it's honestly been pretty good, to be honest.
But I don't have to use this just for garden suites, right? Like I could use it for a second suite in the house, and I could use it as a primary place of residence. If I was buying a house that my family wanted to move into, I could do this. I could use the same thing. Correct.
Same thing. So yeah, let's say that's what I had funny. I had a call the client yesterday, and he's not an investor. He's just like, him and his wife are selling their house and they want to buy a new one. The one that they were buying, he called me. He's like, oh, it's terrible condition. He was all nervous about it now, basically. And I was like, well, we can do this. And we gave him this option with the renovation loan, and he's going to put an offer in tomorrow now, right? Because he's like, oh, that's perfect. I didn't have the money to complete the rentals, but now I can basically put an extra 200 grand into for his case, it was the main level and some of the upstairs, and they're just going to renovate it for their family to live in.
And the interest rates on this, is it best rate, a little bit higher than that?
No, so it's good. So the interest rates right now, while the work is getting completed, you're sitting at basically today, and these rates do change obviously as the market moves, but today it's 6.09%, and it's an interest only payment while the work is happening. So that's what the rate is today. And it's basically our 6-month rate that's being offered on it. And it's an interest only payment as well. So it's a pretty competitive rate in terms of construction financing. Typically that number is going to be 9% plus 3% lender fee, right? And so that part's pretty competitive on that side of it. And then the actual, when it's time to lock it into a traditional mortgage, you're going to be getting bank-like rates today. So we've done deals where you're at 419, 424, 409, depends where, like if it's a rental versus owner.
Yeah, got it.
But you're locking into a traditional mortgage.
Wow. Okay. What am I? Okay. And I cut you off with some of these questions. So if there was
Oh,
more on this,
go on, yes.
no, this is the first stuff that comes to mind. Am I missing the obvious here? Is there what else am I missing on this
I
program?
mean, the biggest thing is the qualification that obviously we have to look at, obviously, and that's where a lot of people are like, that's where we obviously want to talk up front and get all that work done up front, is making sure we can qualify for what we're doing on the exit, right? That's where some people maybe get a little overexcited sometimes, is saying, hey, I can qualify for my house today, and we want to make sure, can you qualify for when it's done? And that's with Dan and mine's job, to basically work with the clients to say, okay, here's your plan for the house today. Yes, you can qualify to buy for $700,000, but we have to now make sure that you can qualify for $880,000 or $1 million, whatever that number is when you're done. But we'll do all that planning with all the investors beforehand. And so the idea is you're going to end up having a process where you know exactly where you're getting into before you do it. And then so people go, okay, so where's the hiccup? And I guess that's where the question is. The two biggest areas that we're likely going to see, and it's a lot of it's market dependent too. So in the year from now, if the market's all of a sudden going crazy, we laugh because it's never going to be a problem for the next 8 months kind of thing, right? Where you'll see some appraisals come in. And then the other big thing is there's always any construction loan that's done is based on who the percentage complete. The appraiser goes out and says, hey, you're 29 or you're 38% complete, and you're saying, no, I think I'm 45, right? And so that's always going to be a little sticky.
Yeah, but that's normal construction fine. That's like the normal battle of anyone's going to. That's no issue. Okay, what about is there a length of time I need to complete this project in?
Yes. Yeah. So it's a good question. So so the rule we have right now is anything under like basically like a 60 to 70 grand renovation, you have to do within like 6 months. But anything bigger than that, you have 12 months to do it. And then if it's a massive one as well, where we know upfront it's going to take 18 months kind of thing, we can basically bring it to our exception team and see if we can get it done.
Okay, so then what is the minimum and the maximum on this program? Is there a minimum amount?
The minimum's like 50 grand. I'd be willing to do less too if we need to.
Okay, and the max?
No max.
No max, as long as they can justify it. Appraiser goes in, you have the contractor quote for the work, and everything looks good. Okay.
And I think it's important, just to jump in, guys, I think it's important to just reiterate too, because we get a lot of calls on this for commercial. This is for residential, right? So because we get a lot of calls about commercial. This is a residential.
This is the kind of financing you would more see in the commercial world. Like this to me sounds like more commercial financing that you guys have created for the residential world. You know?
Yeah, more or less. Yes.
I don't know if it's exactly that. It seems very similar to me. Like this is the kind of stuff that we were dealing with commercial.
Yes, it's exactly it. It's 4 units or less right now for this stuff. And so it's been working pretty well. I mean, and the other thing, and to your point, when you say no maximum, like it's to the point where we can do this with full rebuilds. So if someone, let's just say, wants to build a triplex, for example, right? They have a current single family home on it. They want to demolish it and build a full triplex. This program still works. Right. And so if that's a $1 million build, that's no problem. If someone wants to build a custom home on their property, they have a house in downtown Oakville, for example, to say that it's an old bungalow from the 50s, 80s. I want to tear it down, build a custom home. This program still works for stuff like that. So it's definitely like this. And so to the point, no maximum, we're doing some large ones even right now, for example.
Okay. That's probably the most wild thing you've said so far, is that like you can use it on a house that you can knock down and build on using this type of financing.
Correct. Yes, it's something we put a lot of work into. Listen, it's one of those things.
So this is just your relationship with the lenders that's doing this, because this stuff's difficult to get in the residential world.
Part of it's definitely like a very big piece of it is what we've been able to build. A lot of it too is the type of clients that we've obviously been accustomed to working with in Rockstar and things like that, where we're coming to them, we're going to different obviously institutions and saying, hey, look, this is a product we want to put together, offer it through us, because obviously when you stuff like this, you can already see the writing. Well, if it gets massive, 1 million different brokers, you guys are doing, you're going to run into problems. But we're saying, look, here's been the past 15, 20 years of our track record. And we brought them deals. Here's all the clients. Here's the type of clientele we work with. Then they're sitting there going, okay, well, through you guys, then we're willing to offer this, basically allow you to offer this product to people. And we'll back
Okay, so before we move to the other ones, anything we're missing that you guys want to share on this first one?
That was the biggest thing, to be honest with you. Yeah, those are the big. Anything else?
Okay.
Dan?
I wanted to add just,
level.
we were talking earlier a little bit about where some of the challenges are in terms of value and stuff. So I think it's a good reminder that having a team is super helpful on this program, working with the right realtor. So the realtor ahead of time is helping you with the comps, helping you with potentially the construction costs. Now, some investors are more advanced maybe in those areas than others, but it goes to show that working with the right realtor and the right partnership can help mitigate some of those challenges and surprises down the road. We want to avoid those surprises of potential. You don't want to do all the work up front and then find out that when you submit the deal that the numbers are all off based on the final value. So keep the circle close, work with a good team, a good realtor that's going to help you, an investor focused realtor, help you go over these numbers before you're presenting it to the bank. It'll just help cut time out.
Yeah, I guess why I'm just so caught off guard by this is just like maybe just because I've been so many years in this industry. And I've never seen financing quite like this. Like you could always do this kind of thing with private money, like you're saying, add on to an existing mortgage and get access. You use your own HELOCs from another property to do this, but to do it as one kind of seamless product right at the get-go, and then remove the risk that you take to the appraisal on the appraisal that you would get post renovation or post construction. It just kind of blows my mind that you guys have
we've even had a couple where it's like the appraisal didn't come in where we wanted it to. Now, to be fair to the client, though, they didn't put $1 into the project yet. So it's all just a thought first. So it's like,
that's what I mean. It's removing all that risk, because how many times have we all done something where you're like, hey, I'm going to do this to the property, hoping the market doesn't change and the appraiser is going to be a good, favorable appraiser. So then you have to go back and refinance and just hope that you're going to get the price.
A good thing here, Tom, too, is through the process, it's the same appraiser, that's coming out for the visits on the draw. It's the same appraiser that's helping you through the whole project.
Okay, so then on that, what happens if the market just absolutely tanks from here?
You already have
to go to horrible, So like just a horrible. We're talking from this point today, 40%, everything down, every property, every type, right across the market.
So I'll give you an example, actually. This is why we know it works. So this is something we pushed for, is that once we issue paperwork to a client, it's not changing. So it's something we really pushed for. And we knew it was a possibility, because let's say, for example, because we have something that we'll get into that we can offer now as well, but and obviously some other banks have this style program where if you buy a new construction property and you get an approval 3 years ahead of time, you can go to banks and get an approval 3 years out for a new construction condo, for example, in Toronto. And so if that's done, guess how many people are closing with those approvals today on properties that are worth $300K less?
Sure.
Right. So it's happening, I guess, is my point. It's like that part of it is yes, because you would think logically, why would
so then let me take you to the other extreme. And now maybe I'm asking for the world, but let's say the construction on this project takes a year and the market, the Fed in the US cuts rates, Canada aggressively cuts rates, things just rip. Like I'm just taking an imaginary situation here. What happens if it's like, Lorenzo, Dan, I need to can we redo these numbers? Because this property isn't worth, after construction, it's worth $500,000 more.
So the answer is yes, you can still do that. Now, you're in your current mortgage, right? So let's say we transition to the new current mortgage, right? That part's already set. That part's already happening. We've done the transition. We can set it up in penalty-friendly mortgages as well for you, where if we have an inkling, a thought that this thing's going to start, the market's going to start going crazy, then it's like, okay, no problem, small penalty to leave, if any, and then we'll go back and go to a different bank. Now, maybe it won't be necessarily through basically this program. We'll just go to a normal bank and refinance at a higher value. So yeah, it's possible.
Okay. So Lorenzo, when you say set that up, you just mean that we might have to refinance it. Correct. We've already committed to that mortgage.
Correct.
Yeah. Okay. Got it.
Correct. Okay. Which, very doable. And I talk to people too. And the other thing, I guess on the back, I was going to say, with appraisals coming in sometimes a little bit shy too. I've had a couple right now where we're talking to the client and it's like, hey, listen, when we figure all the numbers just based on this appraisal, you're building this whole garden suite, but you're going to end up leaving in about $40K to the project. Right, you're going to be stuck in, and the client's still sitting there. So they're like, well, so basically, you're telling me for $40,000, I'm going to be collecting $2,300 a month in rent, and the answer is yes, and they're like, still makes sense, right? So a lot of times too, you don't even necessarily need to have the full, but you don't always need it.
Yeah, exactly. Yeah. Okay. So then, wow, that's congrats, guys.
That's the main event, to be honest.
Yeah, that's a big one. That's a huge one. Yeah. So congrats on that.
Yes.
And that's live. If anyone reaches out now, I know you haven't done a big launch on it, but
But it
you
is
guys are
live,
live
correct.
with this now. Okay.
Correct.
So what's the next one you wanted to talk about then?
Yeah, next big one too is the next big one we call it scale break. And basically what this one is, this is for seasoned investors that have been obviously being real estate investors for years. And it's for people trying to really scale their portfolio. So traditionally when going to apply for banks, pretty much every bank will cap you at about 10 properties. Some banks are even less. And so we obviously used to come into Rockstar all the time. So, okay, this was our plan to back in the day be able to get you to 15. We'd go to TD for a bit, then you'd go to another one, Scotia for a bit, and then we're capped. Time to go to CIBC because they had some good rules at the time. So those have all changed. And so obviously getting past that 10 number, like all the banks have changed rules. So getting past the 10 numbers become almost impossible unless you're working with B and private lenders as well. So this scale break program that we came out with, again, very similar to the way we approached buildup, is we went to basically a couple of guys and said, hey, we need to be able to build this for our investors. And so this one will allow us to go up to 40 units. So you're allowed a total of 40 units now. And the qualification on this, because that's where this big one comes into play, the qualification to keep buying properties or refinancing your current portfolio was only based on the cash, or not only, but is primarily based on the cash flow of the portfolio. So if you have an owner occupied and 12 rental properties, we can actually get approvals based on the overall cash flow of your portfolio now and allow it to go up to 40 units.
So for somebody who's owned properties for like 10 years, it has cash flow, but then they've been capped and they still want to do something. Now they can come to you and say, hey, look, I'm cash flowing here. Can I keep borrowing?
Yeah, and the big one, again, someone owned property maybe 10, 15 years, they've accumulated their RSPs have grown, their investments have grown. They have a couple $100,000, $1 million in investments. They have 8 or 9, 12, 14 rental properties, but they retired because why do they need to keep working anymore? And
which is common with what we see with people. Yeah,
exactly. They retire, right? Which is almost every day, but they're getting a little bit, they're on a pension or whatever it is. And they go to a bank to try to refinance, or maybe they want to buy another one that's come up or something. They get obviously told no most of the time right off the bat. This will change that. This is where, hey, your properties are cash flowing. You have some liquid fallback. Like we can see that you're someone that has obviously strong kind of liquid. When I say liquid fallback, RSPs, TFSA, like assets like that. Not crazy number, but just it's strong, and you have a really strong portfolio. We'll be able to lend to them now.
And is there a percentage of cash flow? I guess this is just case by case because it depends on their unique situation.
Yeah, a lot of it's case by case. To be honest with you, on that stuff, that's something that when it gets into, like, there's a lot of obvious ones that we can just approve ourselves. To be honest with you, where we're like, we look at it, we can just say, yeah, that'll work. And there's a couple now when it starts to get a little bit tighter, that we'll have to bring it to those particular investors that we worked with on it and said, hey, can we issue on this? But,
based on this person's situation, the amount of equity they have, amount of cash flow.
Eyeball thing, but it's a lot of, well, the one thing I will say, it's a lot of logic. Right. So if someone comes in with, my portfolio doesn't really cash flow or and have $25 in the bank, it's going to be tough. But anything stronger, we can get those done.
Okay. And is that one live right now too, or no? That one's going to be launched
live as well.
That's live as well. Okay. So the third one then is. Sorry, Lorenzo, if you need a break.
Dan, you want to go?
I can jump in.
This is great.
Lorenzo needs a little bit of a water break. That's
Go ahead.
We have our vacation rental property program, which is, Renzo, what's the name of that one again?
Stay Flex.
The Stay Flex, right? So, traditionally, getting mortgages on short-term rentals or vacation properties has been a challenge. Banks don't often recognize when you're buying an Airbnb, they don't recognize the rental income that's coming in on the Airbnb. And in some cases, when you own properties that you're Airbnb-ing, they don't count the rental income on the Airbnb properties. So it can cause a debt service issue and can cause a challenge getting approved. So with this program, we now have the ability to leverage the Airbnb income to help an applicant's debt service lower, thus increasing their pre-approval. So opening the door now to be able to purchase openly what an Airbnb and leverage the rental income will now turn into more approvals for people. Traditionally, if you're buying a cottage and you're buying it as a rental, the bank would likely have a problem with that because their idea of a rental is a long-term rental. So it's a 12-month lease, straight
Yeah,
rental.
not like a seasonal or
Yeah. And
got
you
it.
as an Airbnb owner would argue, but I make more than what that is. I make more. There's more cash flow coming in. So why does that make sense? Well, in the bank's eyes, they don't like short-term rentals and they don't like rooming houses. And not that an Airbnb falls under that, but it just doesn't fall under a typical cookie cutter approval of it, like a single family home or a duplex. So these have always traditionally been a challenge. But with the growth of the industry, the Airbnb industry, the popularity of it, it's something that, again, that we've been forced to recognize would be something that people need financing on. So through this program, again, it allows higher pre-approvals. We would have been limited on people's pre-approvals to buy these vacation properties because we would have had to call them secondary homes. And secondary homes, there's no rental income coming in.
Yeah, so you couldn't recognize the rental income.
You couldn't recognize it. So
now you can recognize the rental income, which is higher, usually on seasonal vacation rentals. Even if it's your own cottage, you can now rent it out and use some of the income that you're going to get from it to help qualify.
Exactly right. So more options for investors there.
Okay.
That one's a good one too. Actually,
that one, just because everybody just got lambasted with that before. It was, as soon as you said seasonal, vacation rental, midterm rental, short term, whatever, banks just ignored it. So you were kind of out on your own, and you couldn't recognize really any rental income on the purchase. So now that changes it. I'm surprised. So like this is, I guess I'm just slightly curious. Like this is just because you went to the lenders and described the situation, have that relationship, and they came up with this product.
But this one has a bit.
So they're trusting you guys.
Yeah, this one's got a bit more stipulation on it too. Like we're pretty much stuck with Ontario only for right now. For
because the other ones were across Canada.
The other one, that one's Canada-wide. Everything else is Canada-wide. This one's Ontario only right now. Now, with that said, this investor, we talk about this Airbnb program or any of these programs, they're through us. We still work as a full-service mortgage brokerage with the banks. So if you're coming to us, and everyone's been doing these deals forever anyway, and you bought a vacation property in Mount Tremblant or Revelstoke or Collingwood, or Collingwood now is Ontario, but I guess outside of province, we're still able to get deals done. But just the specific use of this program, technically it is Ontario right now.
Okay. So that's three great programs, and then there's more. So
there's two more. So these ones aren't as big, and one of them does come with a bit of caveats, I guess I would say.
Tell us.
This next one we have, it's called our Rate Edge Guarantee. And so basically what it is this is only for real estate investors now. And basically if you're working with another mortgage broker, we can effectively guarantee that we will, and you're not using any of these other programs, the specialty programs. So you're just saying, hey, I'm going to buy a regular rental property. I'm not needing any special programs. It's a very straightforward purchase of or refinance of a rental property. We can effectively guarantee will beat every other mortgage broker's rate in Canada right now. Or for this, if you want to pick through the use of this program. So there's no hidden fees on this program. There's no catches other than as long as you were competing with another mortgage broker. So let's say you're working with another broker in Canada. They had an approval at X bank. You bring it to us. We will basically guarantee we will have that rate beat, or we'll pay you $100. And that's basically the guarantee on it. But again,
because you get people. I'm just trying to think of your shoes. So you get people to rate shop you guys. So what you're trying to say,
we're getting them to necessarily rate shop us, but it's more sometimes people will come
that just happens. I think it's like with every profession, people will call 3 lawyers and get prices and mortgage brokers, and they're not telling you. So you're trying to nip this in the bud by saying, hey, listen, you're going to get the best rate if you deal with us.
Yeah. And we know we're dealing with lenders and products that, and again, I'm not trying to say it in a confrontational way, but we're just dealing with products that we know have better rates than what mortgage.
So how would I'm believing what you're saying, but I guess I'm just trying to think of the other side of this equation, the person who doesn't know you well. How do they know they're getting the best rate, really? I guess they're still to take your word for it, right?
That would be, well, to be fair, they can feel free to shop it with mortgage brokers.
Okay.
Right.
Okay.
So if they're like, hey, listen,
they've done a bit of homework and ask around, and then they come to you. They know that you guys are going to be the best rate.
Correct. But we will beat whatever rate they currently have. Correct.
Okay. Okay. And they have to, because I'm just thinking now for myself, guys. I'm like, well,
Yes, yeah. If you want to try to
I
get
got a rate of 1.5%, guys. Like, I don't know. You tell me you're
if
getting the best rate. So you guys just know. Yeah, yeah. You yeah, having its emails that my brother sent me that says I got this rate. So you guys, you know the industry well enough that there's obviously who's kind of bullshitting you and who's not. Okay.
Yeah.
Got it.
But
okay.
yeah, if you have an approval from a bank that deals with mortgage brokers, from a mortgage broker, and most of the time, the way this more so works is someone dealing with someone else, and they have that approval. They've already been given it to us. They come to us, we will beat it.
Yeah. Okay. All right. So and then the fifth one.
And then the last one, probably the smallest of the five, and this one just more as a very niche program, but it's set up for condo conversions. So some investors will want to try to buy condo conversions. So basically, it's people who will basically have a recently converted condo. So typically, they're potentially older style buildings, sometimes new builds as well. But it's condos that are recently, apartment units that are recently converted into condos. So in a very short amount of time. Traditionally, every bank has basically said no to this. You'll get the odd one done here and there, but we've been able to come out with just basically a program that if you're someone that's looking for financing on a unit like that, we can help with that as well.
Oh wow, okay, yeah, I've never really
heard not very big again, like not very big, but that rounds out the five effectively.
Yeah, got it. Okay, so the big one still to me is the Airbnb one's actually pretty big too. Vacation rentals, recognizing rental income on that kind, that's pretty big. The first one though, I'm just curious. It just came out. So I come to you basically on any property, primary place of home or an investment. I'm going to put a second suite, garden suite, or if it's primary place, I'm going to do some renovations. And I say, I don't want financing on what I'm buying the property for. I want financing on the future appraised value before any of the work is done. But I have this quote from a contractor that shows that I am going to do this work. You are going to get an appraisal on the completed value of the project. And I'll know this even before I guess I can go firm. I guess, can we get this done before I'm going firm on the deal?
So on the purchase, it becomes a little bit tougher just because of the time it takes. And the reason it's slightly tougher is because, so yes, we can get paperwork in place. Is it enough for someone to firm up? It's a little bit tougher. And not that the actual financing part takes a while. It's because most time you're building a garden suite, you need permits.
Yeah.
And so in order to get you kind of put in the cart before the horse, sometimes permits take a while. Now, what we can say is so that's where it is definitely doable on purchases. It's the permits that often will make it a little bit more challenging.
Yeah, that slow us down. So if I already had the property and I'm going to do this on it, I can say, hey, can you just give me financing on the future appraised value of this before I even put a shovel in the ground here, before I hire this contractor and give deposits? That's really the sweet spot.
Exactly. Now, if you know you can get the permit, though, we can still get an appraiser out there, right?
Yeah.
We still get an appraiser out there, so we can.
Yeah, but on a primary place of residence, if I'm just, I guess you're going to need a permit on most things. Yeah.
It depends what you're doing.
Yeah, it depends, though. Yeah. Yeah.
Because if I have the stuff, you don't need permits.
Exactly. Like if I have a property that's kind of like run down and I'm going to update things, I'm not really I don't have to go for permits. And there's going to be a difference in the appraised value after I do, let's say, all the bathrooms, the kitchen, finish a basement or something like that. So we could get appraised value on that before the offer even goes firm. Really?
Correct. Yeah, 100%.
Yeah,
that's exactly how we can do it. So that's definitely possible. That's the only little.
And then where are you seeing people use? I know it's brand new.
Yes,
but you've seen a few case studies so far. I guess it's investors doing a second suite or garden suite. Is that the sweet spot you're seeing so far?
That is this right now the sweet spot. And I think as we keep getting this out, that's going to be where it goes. Like to be honest, I'm using it for one of my places in St. Catharines. Like I'm going to be going through.
Yeah, sure.
And to me, I just don't see the reason you don't. To be honest with you, especially if you have existing properties. Like if you have the space on your property, why would you not just add to it, right? But anyway, so that part's a big one. The other one, and maybe it's just some of the clientele we deal with, obviously, is we're starting to see a lot of new construction. Not a lot, but we're starting to see decent amount of people who are building infill, like custom homes kind of thing.
For themselves.
Correct, for themselves.
Okay.
Because traditionally, again, those types of people, they'd be getting a private, they would be scratching money. They're trying to refi after again. So that kind of stuff's been pretty competitive. Like we've seen that as well. Now with that stuff, obviously, if you're doing a full build, you have to deal with primarily, and again, we can work with you, obviously, depending who your build is, but most of the time they have to be like a full new build, like a Terrion certified build or that kind of thing.
Yeah. You can't have your brother in a pickup truck kind of just doing this.
Or someone at least reputable. But I mean, everything's case by case there too, so we'll work with people on that. But you have to traditionally try to deal with someone reputable for it.
But the difference on rates is going to be pretty huge, because if we were doing this before and you go to privates, like I'm kind of in the double digits on rates here.
Yeah.
On
And
the extra,
fees.
maybe. Yeah. Sorry.
And fees.
And the fees. Sorry, Dan. Yeah. So can you just explain that to anyone, just the difference between what you were doing with privates before versus this program? Because I think it's interesting.
Yeah. Yeah. Private rates typically, depending on the position, these are typically second mortgage position. So you're going to be anywhere from like 12 to 14% on that kind of money, maybe lower, maybe 11 to 14. And then typically you're going to be paying upwards of 3 to 4% in fees, when you get in lender fees and you get in broker fees. So we mentioned it earlier. So you're taking what's that, Renzo?
Double legal fees.
Yeah, double legal. Yeah, exactly. The double legal fees you got to pay because you have to pay the private lender's lawyer, right? You pay your lawyer and you pay the private lenders. So all these fees start adding up. This program, the rate, to Lorenzo mentioned earlier, 6.09% interest only, and the fee is a 1% broker fee. That's it. There's no lender fees on this product.
And the point of conversion to like the regular rate that you would get is, I guess, just construction is now complete.
Yeah, and you want the lower rate.
Yeah. So, but yeah, to when it's transitioned over,
The appraiser comes out and kind of certifies. Yeah, it actually is
your
complete.
occupancy certificate. So like, let's say you're building a new build or the garden suite, the cities have to give you an occupancy certificate.
Okay, we're done. Now we can flip over to the best rate.
Exactly.
Yeah, cool. Okay. Yeah, awesome, guys. I can't wait to see where this goes. Good for you guys. Congratulations. I mean, like, what a journey. It's wild just to see what we've been through on mortgages for the last like 15, 20 years, on everything that's kind of like changed over the years. Right. And that when we started in the like 2006-ish, that was the era of like 0% down for everyone and investors.
Oh, I remember.
I think it was our late finance minister, Jim Flaherty. I think like he kind of reined it in after just like 18 months. I think it was the end of what the US madness was doing. Like I think Canada saw, because the US was doing like basically anyone who could fog a mirror can get a mortgage. And I think Canada was like, oh, maybe we should do some crazy stuff too.
Yeah.
Aside from some minor changes to, maybe 30-year AMs for first-time home buyers, it's only ever gotten more difficult to borrow money from a bank since I've been in mortgages.
Since that era, 2006, 2007, it's only got more difficult. And I think that's why you shocked us with this. Is the first time where we've seen something where it's like, holy crap,
positive,
got easier.
Well, hopefully we say that. Hopefully this signals, because listen, that's, the evolution hopefully of lending is we start to move towards new product, hopefully, and that's this is a good start.
Yeah Awesome, guys. Okay, so where can people find you, online? How do people reach out to you? Where do people find you?
Yeah, they can reach out to us at bmselect.ca. They can email us at info@bmselect.ca. They can email myself, Daniel, at bmselect.ca. Lorenzo, to follow the trend, would be the same. But that's, reach out to us on our website, reach out social media. We're on Instagram, Better Mortgage Select. Pretty easy to find, pretty easy to get a hold of.
Anything else thank you for that. And anything else that we haven't asked that we should be?
No, I think we touched, honestly, the biggest thing is we touched on most of most people just, reach out to us. We'll, like, everyone's got their own individual scenario and like kind of how it works. So obviously reach out to us. We'll walk you through everyone's kind of personal scenario. But basically, if from a high level, that's effectively what we've been working on. We've been working on this whole time.
This might be the first podcast I think I've done, right, or live, where I didn't get asked, well, where do you think interest rates are going?
That doesn't matter.
Okay, so sorry. Time out. Now that you asked that, now that you suggested this, where do you think interest rate? I'll give you my crystal ball projection, but what do you think is going to happen?
Renzo, you want to go first or you want to go second?
Up to you.
No one's holding you to any of this.
I think by the end of the year, we'll probably see a quarter point. I'd be surprised if it was anything more than that. And I think probably by the end of the first quarter next year, we'll see hopefully another quarter point. But I don't know after that. Like, I wouldn't be certain we're going to see more after that. So I think within the next 6 months, I would say, I would probably say a quarter to 50, but hopefully that's not optimistic.
Okay. And I'm just curious. I don't know if you follow do you think the US is similar, or will they be different than that?
I mean,
I don't know if
historically, yeah, we have to follow
Similar.
the same
Yeah.
trends.
Yeah. Okay.
So I would
Okay.
expect them to be cutting interest rates, maybe even at a faster pace.
Yeah. Yeah. Okay. Thank you, Lorenzo. Remember, we're not holding you to that, but okay,
Yeah,
John. Lorenzo.
I mean, I could see 50 would be, in my opinion, the absolute max. Like, I think over the next 12 months, one cut is probably doable. Like, the only thing that
just one cut over the
the
next
only
12
thing
months.
that keeps me really worried about this is that the longer and like these tariffs start to persist, where if I assume at some point they're going to tariff them, like we're going to tariff them back at some point. I guess that would be maybe my assumption, and maybe that's a wrong assumption, but who knows? Is that our inflation right now is ticking up a little bit, and CPI and like basically core inflation is actually a little bit high. Like I can't remember the last report; it was like 2.7 or something like that. It was a little bit higher. And so we were actually at a talk with the chief economist at Scotiabank, and he used to work for the Bank of Canada under the last finance minister. And
These are not reputable people.
Which are not, but the one thing, but the one thing
I'm sure he's a nice person. I'm sure he's a nice
but
person.
the one thing he did say where I was like, okay, like, and this isn't even taking his word for gospel, but what he did say is when they look at all of the economic data, GDP, unemployment, the number one thing they look at when deciding for a rate over everything is that core inflation number. So he said you could have every number going bad if core inflation or regular inflation is too high. It's going to make them really like stop and double think what we're about to do.
Yeah, so that's fair. It's just I hear what they say, and then do you remember January 2022 or 2023 when we came back from winter break? Was it 2022? And property prices had gone up like 30% in 30 days. Yeah, like I think it was was it January 2022?
2022 would have been. 22. Yeah.
And that Bank of Canada meeting, they didn't cut rates. I don't know if you remember in January, they did not.
And the
entire world knew that the real estate market was going. It wasn't even like this. It was going straight up like a rocket. And the Bank of Canada meeting, they didn't cut rates. And I thought, okay, like, I don't know. So I hear what they say.
Yeah.
So you think within the next 12 months, up to 0.5 point cut?
Possible. I think that would be like that would be pushing it. Like that's pushing it, in my opinion.
And I think this is the consensus. So I'm just going to go opposite. Like I think the US is going to do 3 rate cuts before the end of the year, quarter. And I think Canada is going to be pushed into a situation. When I just look at the real estate activity across the country, like we didn't release a budget in this country in the spring.
Yep.
Because who needs budgets?
Yeah, of course.
And I know we're going to do an update or something in the fall. And so our next budget, I think they're going to freak out when they see the data in Canada on whatever Stats Canada data they pull internally in the fall. And I think we're going to get matching rate cuts to the US. Like maybe it'll be at a different pace. So like if they do quarter, maybe we'll do like a quarter, and then it'll be like December or January. We're like we're doing a 0.5 point because they're going to have to release a budget in the spring, and the economy in Canada between tariffs and what's just already happening in this country, the trend looks to me horrible. Like new home sales in the dumpster. It's all dumpster fire. Condo sales just non-existent. New home sales non-existent. Real estate as a percentage, real estate and construction as a percentage of economic activity in this country is huge. And I'm not even saying any of this is like any of this is right. Yeah, it's too big. It's actually wrong. Yeah. It's all wrong. But I'm not trying to argue what should be. I'm just saying the reality is real estate is a big part of this economy. So I think Carney's going to, as an ex-Bank of Canada governor, he's going to freak out when he looks at the numbers in the economy in the fall. I think we're going to be 6 months from now, we're 0.75 point cut in this country.
So here's a question for you then. If that plays out, do you think, because inflation
with the higher inflation, sorry, go ahead.
Yeah. So inflation starts to tick up again like crazy. Do you see them then doing a quick pivot like after 2 years kind of thing?
Yeah, I think we're just remember, like debt to GDP is so screwed in the US and in Canada. Yep. You have to use financial oppression against the people. Yep. So you have to use inflation to make the debt look less as a percentage of GDP. So to do that, you must inflate the GDP. Mm-hmm. So I think they're going to come up with like a wonderful way to excuse themselves from saying, well, inflation's high. So either manipulate the data, which I think we all kind of know they do. Like, does anyone really believe our inflation rate's only what it has been? So either manipulate it so it looks lower and they're like, oh, wow, it's lower than we thought and we're free to cut rates. Or they just come out with a reason like for the fairness of the country of Canada, for the fairness of Canadians, we didn't want to do this, but we have to. Or there's another way, I guess, guys, that they could cut rates is, or make liquidity more plentiful is, not cut rates, but bring 50-year amortizations in.
Yeah.
and just say, okay, you know what? We are very prudent. We
Yeah.
are not going to cut rates in this country. We are very responsible central bankers.
Yeah.
But every Canadian deserves to buy a house. So, you know what? We're going to, and they won't call it the 50-year amortization, but they can call it the Fairness in Equitable Real Estate for Young Canadians program. Yeah. And behind the scenes, it's a 50-year amortization. Then, Lorenzo, when you're doing the underwriting and the rate is now, you're using a 50-year amortization, now the expense on that's way lower. So they can keep rates. They don't even have to do any cuts. But that would get some activity.
That would definitely, it's everyone's payment focused, right? So
everyone's payment focused. Yeah. So I think if they don't cut rates, we see something like that come in, that they say, okay, yeah, we're not cutting rates. We're very responsible, but we'll all know what they're doing. And they're kind of like juicing the markets.
Yeah, so I can see the yo-yo thing happen in a sense of like drop right back up. Right?
I don't know if you remember at a few events ago, we were talking about this decade is the decade of volatility.
Yes.
Like the 2010s was just like so stable. Remember, it was just like low rates, property prices go higher. And this is the holy crap. Okay, we have too much debt. We got to, inflation's too hot. We got to raise rates to get this under control. Mm-hmm. But now there's not enough liquid funds in the economy to make all the debt payments. So they have to find a way to inject liquidity. Maybe they'll say beautiful words to make it seem like they're not doing that, but, you know, get some money flowing around there, get the economy inflating up, and then just quickly kind of dial it back again. So I just think it's going to be, but anyway, we'll see. None of us have
volatility. It's the key word.
Volatility, right. Just wild. Yeah. Anyway, guys, thank you so much. Really appreciate your time, and congrats again on getting these programs. Awesome.
Thank you guys for having me.
Way to go.
Thanks for having us. We always appreciate it.
Thanks, guys. Yeah. Go Bills.
And Jays.